Today we brought together some of the people who we need to make financing for development work. And I look forward to hearing their views, and I look forward to lots of great conversation and also disagreement. And I think by the end of this session, we will have solved the problem of financing for development.
Success depends in large measure on financing. Without financing support this agreement, our commitment will just be words on paper.
Now, in this session, we're trying to cover a lot of ground. We're going to start by looking back at where we've been. Then I want us to look at the role of official development assistance, also how to grow domestic finance, and finally also what the private sector can do.
The financing of development has squarely first and foremost to focus on the countries themselves, generating additional resources. So ODA matters, but generating your own resources matters even more.
If we're going to reach a goal, eradicating all extreme poverty by 2030, we have to think differently. And when it comes to ODA, we need to make sure that the ODA is as consequential and has as much impact as possible.
So why don't we begin by an understanding between the private sector and the governments that we need investments, but also they should pay taxes in their own countries, in the countries where they operate. Now, that may require that we help countries with capacities to negotiate good contracts and to execute the contracts in accordance with international best practices.
When you talk about the need to have a public-private partnership, there has to be a return on capital for the private institutions to want to invest. And that means that there has to be market pricing for if it's energy, and the country has chosen to subsidize it at a substantially below market level. It's going to be harder to get investors to be attracted to that opportunity.
We're talking about trillions of dollars of investment that's required. And I think the good news is, I think the capital is available. I work with 290 sovereign funds from 70 countries that account for maybe about $25–30 trillion. And I actually polled them and I said, what's your number one objective in terms of deploying capital over the next 12 to 24 months? And the top choice for all of them was infrastructure.
Because if we want to get the private sector in, then we must speak the language of the private sector. And that means that the private sector will say, I'm ready to contribute if I have a viable, economically viable project, if I have a sustainable project, if it makes sense to invest from the economic point of view. And that is sometimes not really serviced if we just have, let's say, a development goodwill. We have to combine these things.
Infrastructure is a better deal than most corporate risk. You lose less money. Second thing, there is no real difference between OECD and non-OECD. So contrary to what people expect, going to emerging and developing economies is as good or as bad as going to a developed economy. And third one, when you structure the transaction, so where basically we do our job, it's even better. So the problem is a perception.
We heard a lot about concerns about international taxation, the need for developing countries to be ready to receive the capital if it can be freed up from the private sector, and of course this idea of changing the perception of risk. I want to thank you all very much for being here today. Thank you. And also to our audience.